Imagine you go to Chase or Bank of America. If you went in, I have $100,000 as collateral. Let me take out $500K, and they're gonna say, okay, what do you want to use that $500K for? I'm gonna invest in stocks. It will be an absolute no, right? So from bank's perspective, like real estate inherently is much.
You can do one, then the other, like starting stocks, getting real estate, starting real estate, getting stocks, like B just said. You can do them simultaneously. There's not one or the other, which they're commonly painted against each other, like which is better, which does not need to be the case. Do what works for you. It's all said and done.
Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back, everyone, to another episode of Rebel Wisdom. Your favorite two rebels here. Again, I'm Julian. That's my boy Barry, aka B, as I like to call him. And this week we're going to be discussing real estate versus stocks. We're gonna take a deep dive into this and see what we can come up with for our good conversation this week. I would like to preface this with a couple caveats. One, we're certainly not specialists in these fields in any way or official capacity. So again, we like to express our opinions on the topics and couple that with our experience and just hopefully give you some knowledge in the process. And again, this is meant to be very conversational and just get a deep dive into this topic. So starting with real estate and stocks, as you get into adulthood and start to make some money, I think a lot of us, again, both of us are around the age of 30, are looking for ways to expand your money. I don't know about you, B, or the listeners. A phrase I often hear is how to make your money make money. And I think, if you just got money, if you have money that's not actively being spent, which unless every one of your pennies is accounted for, everybody, I think most people in some capacity have, whether a little bit or a lot of money that is stagnant in some sense. When I say stagnant, just sitting in an account, whether it's interest bearing or not, that could be utilized in maybe another avenue. So within those avenues, again, we're going to hone in on the stock market and the real estate market. So I think it's only appropriate that me and B kind of give some insight into our experience with in these two topics and kind of shed light on where we sit on these two things, like what we have going on personally, just a little bit, not getting into the details. But B, do you want to kick it off and kind of give some testaments to like your experience in either the stock market or the real estate market, and then I'll do the same after?
Yeah, at least for stocks, that was like my, dipping my toes into just any market in general. And then pretty much read the book Rich Dad Poor Dad at 22. And then I don't know why a lot of people go into real estate after, but somehow my brain at the time thought stock market. So started investing in stock market. And then somewhere along the way, I really wanted to go all in on real estate. So invested from 22 to 27, maybe 26. At that point, I cashed out my stocks, definitely made well over six figures on that, which was lucky, right? I'm not bragging. It was just super lucky investing right before COVID, into COVID, and a little bit after COVID. Just one of the best, markets that ever we've seen yet. And then went into real estate, pretty much cashed all my stocks out. And then my wife and I own 4 properties today. And we do management for other people as well, but that's pretty much the extent of stocks and real estate for me.
Awesome, dude. I love a good win story, especially for one of my boys. So yeah, that's awesome. I started dabbling in the stock market and never did anything like within the stock market. There's so many things you can do. I've just invested in like individual companies or like an ETF, and we can get into all that stuff around, I don't even know, 2000. So for context, he actually got me into kind of like when his interest in the stock market started. Like, I feel like, I remember like watching you go through the process. I felt like it was like there was never any talk about stocks, or neither one of us knew like pretty much nothing. And then like a week passed, and it was like just every day, like, bro, I found this out. Like, you got to do this. Like, I'm doing this. I'm looking at this. And it was just like knowledge. Like, you were like heavy into it, which is dope. So he kind of got me into it. Again, that's when we were like stationed together at first. I don't know what year time frame, maybe like 2018, 19. I don't know.
Yeah, 2018, 19 maybe.
Yeah. So, and that was very light. And then I was active for those first couple years, like actively putting in. And then honestly, for the past couple years, I've been very passive and just kind of let what I had in the stock market sit. But the money I have gotten since 2018 to present has grown a good little bit. And I was able to take a little bit of that out. I've only withdrawn once to use for some other things. And as far as like real estate, again, and also to preference, we're both talking about residential real estate. None of this will be really commercial, as well as when we go into just kind of diving the conversation, we're pretty much talking about residential real estate. And I have 2 properties myself, so that I kind of partner with my dad, and we kind of manage those. And I've just been fortunate, and all my stuff's back home where I'm from, so has some sentimental value there too, kind of pouring into the local market where I was raised. I felt like my like personal insight on it is, I feel like, you know, where I'm from kind of poured into me, and now I'm like giving back to the local economy or the local community in a sense, while also turning a profit on it as well. So that's like my mind state for that micro economy that is back home for me. So yeah, that's where I sit with it. As we go from here, unless you have anything you want to throw in, B, I was gonna say we could give a quick historical context on both the stock market and the real estate market, just as we go into like how we speak now, what the rates are historically for both.
Yeah, so I do want to say, you know, there's so much conversation around whether stocks is better or real estate is better. And just like anything, is one thing better or the other thing that's better? That's not necessarily apples to apples. So we're going to try to compare it as fairly as equally as possible. But, you know, at the end of the day, like, regardless of what the math says, regardless of what anything says, someone might prefer stocks over real estate, and vice versa, real estate over stocks. But with this calculation, you do have to assume and kind of generalize a lot of the actual numbers. And then I just wrote some stuff down right before this podcast, but the math that I'm using is going to be a set amount of money that, you know, person A and person B is starting with. So for example, it'd be like person A, person B both has $100,000 to invest. And the typical stock side, I just chose the S&P 500 fund, which closely mimics the overall stock market, and did a quick Google search, and it says since inception of the S&P 500 fund, it's returned around 10%.
Wait, real quick, B.
Yeah.
Sorry. I just want to break stuff down. I don't know the varying levels of knowledge of the listeners, like S&P 500. What is it? Standard
S&P 500,
which doesn't really matter, but what it is, like the 500 top companies in the U.S. essentially.
Yeah, basically, yeah. Top 500 profitable companies traded in the U.S. stock market, which is mostly American companies, but, you know, there's obviously other companies as well.
Right, way more than 500. All right, go ahead.
So when people talk about the stock market, they often refer to the S&P 500 for just like a benchmark numbers. So let's say, you know, that returns 10%, and, you know, it grows from that point without putting in money. And on the real estate side, let's say if you have $100,000 to invest, you can. So real estate is kind of like generally accepted to be a leveraged asset. Like if someone said, "Hey, I'm leveraging in the stock market," whether you're taking out margin loans to invest or you're going through options, there's a lot of the idea of risk involved. Whereas in real estate, you put 20% down. So you put 100K down and you buy a 500K asset. That's not necessarily looked at as a bad thing. 20% is very traditional and considered to be safe. And so that's the math. And for the rate of return, you know, real estate is very market dependent. one market could return 7% annually, one market could return 2% annually. But I'm just going off the averages, and based on the Federal Housing Finance Agency house pricing department, I guess, they said that over the past 30 years, nationally, real estate has appreciated 3.8% on average.
And that was over how many years?
That was over 30 years.
The last 30. Okay, cool.
Yeah, so that's the numbers that we're going to be using in this podcast.
Yes, perfect. Oh man, that was a good historical breakdown, just to kind of like level the conversation and where we'll be going with it. So, as he said, this is a very nuanced conversation. It's hard to use so many generalities, but in comparing the two to encompass like most scenarios, I think that's kind of just what we have to do on this topic. So many directions to go. Let's see, like, if from a sense of, I'll back it up a little bit. I think relevance of these two topics, but again, the reason of these two topics are, I don't want to say worth mentioning, but that are just pretty much prevalent is because, again, it's just about turning a profit and how we can make money. So at the like nucleus of this conversation, the biggest thing is going to be like, which one is more profitable, or like, where can you make most money? So keeping that in mind as we go through the conversation, we'll kind of use that as a springboard to like jump off into, hey, which one is more profitable? And we can't dissect all of the things you would have to look at when trying to answer those questions for both the stock market and real estate. But that is going to be the main point that this conversation revolves around, is like kind of which one's more profitable. So again, when taking that question, we'll start with that. Like, hey, which one is more profitable? I'm somebody, as B said, that has $100,000. Like, I want to turn my $100K into more money. And somebody were to ask me, anybody, which one should I put my money into? Like, please tell me. As B said, it's kind of dependent on what that individual person's long-term goal is. So like, hey, what are you trying to do with your money? Are you trying to turn a quick profit and within 2 years get some cash that you can put into something else? Are you trying to grow this to start a business? Are you just trying to generate generational wealth? Money for when you die, you can pass down, right? Like, these are all viable questions that are embedded within the question. Like, hey, how can I make money? It's driven by your personal goal. So with that, I guess we can arbitrarily pick one. Do you want to start with like kind of talking about like stock market, or you want to kind of start on the real estate side?
We can go through some pros and cons, or we can go through the math first. It's up to you. What do you want to go through with first?
Well, I think the math will drive pros and cons. So let's
okay, we can go through the math. Okay, so going into the math, just same assumptions as before. Person A, person B, one investing in stocks, the other in real estate, and they both have 100K to invest. And it's kind of interesting. There's a lot of nuances in the first place, right? With both of them, you have taxes. Whereas in real estate, on the tax code, it is a little bit more favored towards real estate than stocks. On the real estate side, you do have additional like phantom costs, like maintenance. You need to save up for maintenance, and they usually say it's about 1% of the purchase price a year that you need to save. Or other camps are like, hey, you save a couple $100 every single month, so it can cover the cost that's when it comes up. Your sink breaks, you don't have to come out of your own pocket. You already have money in the bank account to fix that. So there's a lot of nuances, but I'm gonna just go ahead and not count those in, because it is a valid argument that you need to count those for real estate. But for majority of the cases, your PITI does not. Your PITI is your principal, interest, taxes, and insurance for real estate. That's like your mortgage payment that people talk about.
Right.
They don't generally go up as much as rents do. So I get it, like mortgage rates, the principal interest for a 30-year loan never changes, but the taxes and insurance, they do generally go up every year.
Mm-hmm.
But rents definitely goes up faster when you look at it in the longer term horizon.
Right.
For the for maybe the first 10 years, it might be cheaper to rent than to own a house. But after that, market dependent, the rents on the equivalent a unit went up so much more than what your PITI was. So it's going to be more expensive to live on the stock person's scenario. So without counting those in, I just canceled all those out. So we're just looking at the appreciation of the two assets.
Got you. Also, I want to put a tab on the talk later, interest rates, because I think that affects
absolutely
both sides pretty substantially. So we'll definitely double back to that. And
so it's interesting. So year one, you get 10% return on the 100K. So you have $110,000 on the stock side. Pretty easy math. And on the real estate side, because you bought a 500K asset with $100 or with 100K, and it went up 3.8% on that 500K, you have 519,000. Right. So you can already see right there that, stocks went up 10,000 versus real estate already went up 19,000. And you fast forward to year 5, you have 161,000, assuming no more money was put in. And on the stock side, your house is worth 602K. And you owe 372,000 because you took out a 400K loan, because 500 subtract 100 is 400. And the difference between those is 230K of equity into the house, which is definitely over that 161 on the stock side.
Right. So with that example, you do make a little bit more in real estate. All right.
Definitely more on the equity side of real estate.
Yep.
And year 10, pretty much the same story. Stocks is 259,000, whereas equity in your house is over 400,000. Year 15, year 20, year 25, pretty much the same story. Appreciation on your house does go further than the appreciation on your stocks. But after year 25 is where the interesting conversation comes into play, because the appreciation on your stocks does take over the appreciation on your house at year 27. So this is like a weird thing to wrap around, because we are just talking about just the numbers.
Right.
But with any investment style, like, you got to take in the consideration for everyone's lifestyle, right?
Exactly.
And generally speaking, like, more than 90% of the people, they don't hold a stock or ETF or a fund, for example, for over 30 years. Very unlikely. And on real estate side, same thing. Very unlikely that someone buys a house and keeps the original loan for 30 years straight and actually pays it off at the end of 30 years.
Yeah.
But we can make assumptions. So based on the math, I mean, over 30 years, stocks does make more money than real estate. And the only thing I do want to add on to that is, like, because of the data point was over 30 years and the mortgage is usually a 30-year mortgage, I didn't want to go past 30 years to make it complicated.
Yeah, that makes sense.
And it doesn't really apply. But at the end of 30 years, you do pay your debt off you do pay your mortgage off on the house, which means that past, 30 years, you don't have a payment that you're making.
Exactly.
Which kind of,
all right.
I mean, it makes your life easier, right? If you're living in a house, like, imagine getting rid of your housing costs with, I guess it'll be minimal, right? You still have to pay insurance and property tax.
Yeah, insurance, maintenance, maybe. Yep.
Yeah, that's very little compared to the rent that you have to pay.
Correct.
So that is an interesting conversation that we're not going to consider in this conversation, but it is a real thing that, I do like about real estate, because stocks is numbers on your screen, right? Pretty much.
Yeah.
But real estate, like, you get to live in it, which
to feel it a little bit more.
Yeah. There's not, that can't be considered in the math, because a feeling is not a quantifiable number. But
dude,
that's one thing. I mean, that's the truth.
No, that's great. I think, I mean, even in my personal example, like I bought back home. I do think, the area I'm buying at is going to be a prospering area. So I do think for that reason, it's going to appreciate at a good level. But a lot of my reason is, like I said before, like that's where I'm from. I'm kind of investing back in the community, the market that I was raised in. So there's an emotional aspect there. And thank you for laying that foundation, because now we can stem off of that in so many different directions, especially when speaking on to like people's personal preference. So I'll start with like passive versus active.
Okay.
Both can be both. I would say both could be either. So for real estate, again, and I'll base everything off my personal example. I was a little bit, I wouldn't say real active, but a little bit more active when I started around 2018, 19, maybe 20 into COVID. But now very, very passive. Again, I don't actively put into it, but even if I did, you can set up automated payments for whatever, your portfolio you have. Hey, I'm going to put $300 a month into my check from this ETF, which will exchange traded fund, which will disperse that money in the companies within that pool. And I don't do anything but automate the payment every month. I don't have to look anything. Or stocks can get as nuanced as like doing options, looking at individual companies, what's it called, like call sheets or whatever, like evaluating that company and comparing companies based on, it can be very active as far as like your research and how you're managing your money.
I agree.
Yeah. Same with real estate. I mean, if you have the right things in place, like property manager, again, and this is contrasting versus, I mean, if you're living in the home, it's pretty much like you're living there. So you're there, you're pretty much taking care of anything. On the real estate investing side, you may have a property manager, somebody that takes care of your property for you, or you could manage your own properties if you're in proximity or have the bandwidth, etc. So there you can, to an extent, manage how active or passive you are of those things. I would think if I had to compare on a one-to-one basis, like which could be more passive, I'd probably say stocks, just because literally you could just put money in and like that's it.
I mean, based on this example too, like where you're investing into the S&P 500 fund, and you just put it the initial 100K and just letting it sit over time.
You do absolutely.
That's
passive
the ultimate passive. Yeah,
yes.
Exactly.
Yes.
And even the most passive I put for real estate is, I mean, you're living in a house, right? You don't have to manage tenants or anything like that. But with maintenance that comes up, and even if you bought rental real estate, like in this example where you're living in a house, with the good property managers and whatnot, there's still some involvement on your part.
Exactly.
So yeah, I mean, passive versus active, the best case scenario for real estate, it still doesn't beat out the passiveness of like a neutral case for stocks.
Yes. Good. Right. If you have two neutral cases, correct. And I was just gonna say, if you're somebody that's looking like, hey, I'm very, like my time is very saturated, I want to put my money somewhere. Again, you could do either, but the most passive of the two, especially in the examples you could give, I would say stocks. From a passive or for active, passive versus.
Because like without knowing anyone's situation, you do want to just offer the passive. Like if someone was like, hey, real estate or stocks, with no, just a blanket statement, no context to it, I would say stocks, even though that's not what I would do. Right.
Good. And this is where the nuance comes in. Exactly.
Yeah, I do definitely, because of the passive active side of it, without adding to someone's life, stocks probably much easier for people to dive into.
Awesome. And again, when we'll say stocks, I guess we'll standardly be referring to the S&P 500 for, again, the sake of this conversation. Right. So that's great. Another thing, which, I don't think it really came up in the breakdown you just gave, but one thing to consider is how fast are you trying to take out your money from one of these investments, like the liquidity piece, which I think a lot of people would be, usually would know if you're going into either of these situations, maybe you're just getting started with no end state, but I feel like a lot of times people are going to know, maybe generally not like on this date or this month, but a time frame in which you want to use the money that you're putting in, whether it's, hey, 5 years from now, I want to use this, 2 years from now, 10 plus years, or like you said, the 30 plus, hey, I just need some money. I'm trying to grow in a long-term investment vehicle. And again, this is hard because there's a lot of other long-term vehicles out there, but we're strictly sticking to stocks and real estate. So I think liquidity is a big piece of this conversation too, in which I think it's easier to liquefy.
Liquidate.
Liquidate, yeah, liquidate. Thank you. Liquidate stocks as well versus real estate as well.
Yeah. So which you would think liquidity, I mean, that's overall a pro for stocks.
Mm-hmm.
I mean, there's not too much to that, but I do want to say the more a stock is traded, usually for that stock trader, the return decreases. The best way to do it is just, hey, buy and hold it and don't ever think about it. And in that sense, real estate not being as liquid as stocks also offers a good, like a pro in this case, because you're not forced, but it's very annoying to buy and sell a house. It's not an easy process.
Yes.
So because of that, people tend to hold on to their houses longer. So you're not trading in and out any market, and kind of you generally get rewarded for holding on to something of valuable, with good fundamentals over a long period of time. So liquidity, obviously stocks, I can buy it in 2 button clicks and sell it 30 seconds later and pull my money out the next day.
Exactly.
Real estate, it might take you a month to buy it, a month to sell it.
Yep.
And there's a lot of steps in between. But I would kind of make that equal because it's harder to liquidate real estate. It could also go with you, or like be more favorable to you in the investment side.
What are you saying, real estate? Because it's, say that last part again.
The not being able to liquidate something, it just generally rewards those that it makes you hold onto the asset longer.
Oh,
yeah. So it just
100%.
on the real estate side, because it's so annoying to buy and sell, it might the liquidity portion sounds like a con, but it could end up being a pro as well.
Right. I see what you're saying. Simply because it's almost a deterrent.
Yeah.
Deterring you from selling, which kind of forces you to hold it, which typically is when you get the best returns. Awesome. Okay. Yeah. No, I think that's a good point. So yeah, again, those from an individual perspective, both passive versus active, and a liquidity standpoint, are two things to be considered. And that most people are curious in when entering these, stocks versus real estate. We kind of talked about the returns over time, but there's also a piece of diversification as well. And this has come up in some of our other topics. I'm a big proponent and pretty much like diversity in everything. So for instance, like my stock portfolio, well again, S&P 500 is a perfect example because S&P 500 is the 500 top performing companies in America's, like in our market, which is why standardly the S&P 500 is used to as like a quick barometer, I guess, for like America's growth, I guess, because it's the top 500 companies representing our market. So with that, like if you invest in the S&P 500, just by doing that, which again can be extremely passive, it's already in a sense diversified because there's multiple companies and multiple different industries and sectors within that grouping of 500 companies. So I think that's cool how you can tap into different industries in the stock market, which again, comparatively, I mean, real estate is real estate. There's different things you can invest in. Like I said, commercial, we're just talking residential, or there's, was it REITs, I guess,
yeah,
which
REITs.
is kind of blends the two. I guess that's like stocks for real estate. But again, my overall point is just that you can invest in it and tap into different markets, which could help balance each other out over time in the stock market, whereas real estate is for the most part just investing in real estate. So if the housing market goes one way or the other, like you will feel that based on the current state of the market or the local market, etc.
Yeah, I mean, if the housing market goes down, this is the same thing as saying if the stock market goes down.
Exactly.
But for the diversity piece, I agree with you. Like S&P 500 is already diversified with 500 companies, which is more than what you need.
Yeah, for sure.
But then on the housing side, you could you could do a really good research on, you know, like the overall, like I live in Phoenix. Like Phoenix is a very strong growing real estate market, but that's Phoenix as a whole, right?
Right.
The certain pockets of neighborhood that you decide to live in and invest in, that could be going down or not appreciate as fast. So there is that risk of you do a good job picking, I guess, but then regardless, or because real estate is so local, dice could roll in the bad way for you. But to the counter argument, it could roll in your favor as well. So it's, I mean, diversification, definitely stocks is going to win on this one, but I wouldn't say it's like, just because there's bad and good on the real estate side, it's kind of neutral for me.
Yes. And this is why I wanted to start with kind of like the historical data and baseline it, because to your point, I think real estate is more, you look at the local market you're in, and you kind of want to learn and see like, okay, how is the housing prices or maybe the supply in this area been? Like, how have the residential properties been appreciating? So for the housing market specifically, like you were saying, I think it's more tailored to the local markets, and like the supply in that area, or like how those properties in that local area have appreciated over time. So you definitely want to tap into the history there, which is why I wanted to start with a historical perspective just over both these topics, because when you're looking at these things, stocks or real estate, like you want to see the history of that stock, that portfolio, that local market, so you can buy into it appropriately. There is some things you can do there to kind of curb your success in either, but like we stated, it's easier to be more diverse in stocks, which is, I mean, diversification isn't like, it's just one component. It's not like one thing like to look at, because again, there's a lot of pros for real estate as well. But for that aspect of to tap into different markets, I would definitely say stocks just inherently has an advantage there. But with stocks, on a counter to it being almost inherently more diverse, or can be, speaking on volatility, it's also inherently more volatile.
Yeah, absolutely.
Just meaning like that market simply just fluctuates way more because how the economy moves, and whether a company or a group of companies, I think it reflects and feels that movement of the economy a lot more, or just that individual company, how it's performing. So, man, I've seen like you could be up one day for 2 days, like all your stocks looking green. A day or two passes and like you're down bad, and it's man, stocks can play with your emotions. I'm not gonna lie. So again, whereas in the housing market, it's pretty steady. I don't think it doesn't feel the adjustments as much over time, or doesn't adjust as quickly.
Yeah, definitely.
Yep. Yeah. So that's another component to take into consideration.
Yeah, volatility is kind of weird. Like a lot of people look at volatility as risk in the stock market, which is, I don't agree those are the same, but that's like
kind of
what.
Natural.
But they generally talk about it's like volatility and risk as in the same word.
Okay.
But I mean, looking at the data, like I said, stock market may return 10% on average, but there's a lot of positive years and there's also a lot of negative years where on the real estate side, it may be, less percentage appreciation, but you do have more positive years, a lot more positive years than the stock compared to the stock market, where, there's always a conversation for the actual mathematics of the percentage appreciation on stocks and real estate, because percentage, the overall 30 years, 10%, right?
Yeah.
Or since inception, or whatever the math was on the stock side. But you go into the wrong time in the market, like you could have, let's say you start out with 100K and year one, stock market declines by 50%, let's just say. So your 100K went to 50K, right?
Exactly. You're freaking out.
Next year, let's say it grows by 60%. So now your average return is 10%, right? Negative 50, or so over the 10 years. So it needs to be, second year went up positive, positive 70%. So in over 2 years, it went up 20%, which means
Okay.
average 10% a year,
Okay.
right?
Okay.
So now your 50K increased by 70%, 1.7, is still 85K. So even you had over those 2 years average of 10% return,
Yeah.
your real
not as much.
returns is literally less
Is-
than what you started.
Deficit. Yep.
So that's the volatility portion that could work in your favor or not work in your favor, right?
Right.
So, I mean, with this assumption, because you're holding a stock for over 30 years, it does fall true to that 10% average return. But
Mm-hmm.
when people see that negative 50% in the stocks, like you say, it plays with their emotions. It's
Yeah.
very hard to hold on and be, trust in the process of, hey, even though I'm down by 50%, I'm going to keep holding.
Yeah.
So volatility, because it's a slower moving market in real estate, I do think volatility is definitely on the real estate side.
Mm-hmm.
And I do want to point out, obviously, I have a little bit of stocks and majority of my net worth is in real estate. So I'm definitely biased towards real estate. With that, real estate, I think, is a very interesting asset class because I believe in the sense of money. Like, banks are one of the smartest people and smartest asset allocation and has really good way to look at risk and whatnot. The brightest of the people works at the top
Yeah.
for all financial whatever. If you were to buy a house and say, hey, I'm going to put 20% down to go buy a house, these as long as you meet your DTI requirements and your credit score is good, whatever, like, they're like begging money to give you this 30-year loan. Like, hey, take my loan, take this loan, whatever. So as long as the pieces fall into place, like, it's very, very easy to be leveraged, 5-to-1 in real estate, generally speaking, right?
Mm-hmm.
And even you can put banks are okay putting down like 5% conventional, or even like 3.5% FHA loan, right? So you're leveraged through the roof, technically, right? On the real estate side.
Yeah.
But banks say that's okay, which kind of speaks to me as the, how much less risk real estate has compared to the stock market. Because imagine you go to Chase or Bank of America or whatever, you can get a loan from, a mortgage and a personal loan. But if you went in, be like, hey, I have $100,000 as collateral. Let me take out $500K. And they're going to say, okay, what do you want to use that $500K for? I'm going to invest in stocks. It'll be an absolute no, right?
Okay, this is actually important.
So from banks' perspective, like, real estate inherently is much, much, much safer. So that, I do think that's kind of interesting, and that kind of speaks volume, in my opinion.
From the bank's perspective, that's good. That's good. Which I think is saying something. Like, these are the people that literally handle like money and the circulation of money. So with them being able, like, their comfortability to lend in both of those examples, I think that's saying something. No, that's pretty cool. I don't even think we've ever been like talked about it from that perspective. No, let's talk about some of the. Well, actually, you mentioned it earlier. I don't think we got too deep into it, but another thing to consider for both is the tax advantages, which I think this one goes definitely to the real estate side.
Yeah, absolutely.
Yeah, I don't even. Well, again, in my personal way, like, I can't even think of like many. I mean, there's certainly, like, I think small tax advantages for stocks, but that's only when you like withdraw it, right?
I mean, yeah.
Whereas like real estate, you can get more consistent and, I mean, much larger on average, just depending on how much you have invested in either, I guess, but you can get more consistent and larger like tax benefits.
Because, like, I mean, you can't. I don't want to bring up like IRAs and 401ks into this, because that's like, we're going over 30 years, and if you start investing in 20s, like, you can't even touch your 401k until you're 59 and a half.
Exactly, almost 60.
So it's not really. Now we're getting away from the apples to apples comparison. But then on the stock side, like, yeah, you pretty much. I mean, you get taxed on your dividends. Sure, it's not
Okay,
much.
dividends, yeah. Yeah.
But then like a lot of people, I mean, they're not. It's very hard to live off just dividends, right? It might be easier to follow the 4% rule, where you just take out the 4%, where you assume the stock grows at a bigger percentage than the 4%. So capital appreciation, you generally get taxed at 0, 15, or 20% tax bracket for long-term capital gains.
Mm-hmm.
And if you sell it within a year, it's just considered your active income, like just whatever tax bracket you're in. Not really tax advantaged there. But yeah, on the long-term capital gains side, I mean, you're still getting taxed, but
Right.
it's not. I mean, it's 15% for most people, right? It's like if you're making over 80K as a household, you have to pay that 15%.
Yeah.
So I mean, it's not much, right? But you definitely still get taxed. Whereas real estate, if you live in your house for the last 2 of the 5 years, if you're married, you don't have to pay capital gains tax up to 500K.
Yeah.
And when you buy your house, I mean, you can't claim depreciation because you live in a house. If it was a rental property, you could claim depreciation on your house. But the biggest, you generally take 30-year mortgage against your house on the real estate side, which that's what the example is based off of.
Right.
And within that tax advantage topic of the mortgage, you can literally write off your mortgage interest, right, against your income. Like that's going to be a huge thing for a lot of people in the first like 10, 20 years of the mortgage, because there's so much interest tacked onto that regardless of the percentage.
Oh my God. Yeah.
And then, I mean, from there, you can also write off like property taxes and insurance, which you got to pay the property. I mean, it's like to help out the city and help out a lot of the things in the community. But you can, at the end of the day, you're paying for it, but you can write it off. So
exactly,
I would say taxes, if you do it right, stocks is not outdoing real estate in any way.
Yeah, right. Which is something I mean, even me, like I'm still trying to navigate myself and just figure out the best ways to optimize like tax benefits and whatnot. Because I know there are a lot of advantages for the real estate side,
especially on the rental real estate side.
Oh yeah, definitely. Yeah, if you guys can't tell, B is the resident expert between us for the for the stuff. This dude's taught me so much, so it's awesome having a friend like you, B, for sure.
Appreciate that.
It's funny. One thing on a lower level, we probably should have started with this. That I mean, it's pretty obvious, but I'll just say it just to say it too. Because like for me, when I was getting into my journey and all this, the one thing to look at is like, okay, like how much money do I have? Like, I got to save this amount, like when to start. And we both started, now that I'm kind of thinking about it all, we both started in stocks. And I don't know if that's a function of us being overseas or just like what we learned about first. But the point I'm trying to make is the barrier to entry for both of these as well. It's I mean, easily stocks, just because there's no set amount. Even the cheapest house in the worst market or best market, like however you look at it, the best buying market is going to be thousands of dollars. Whereas you get into the stock market with this, I know, like I just recently, maybe like a year or two ago, I tried to get my mom like, hey mom, like what do you know about the stock market? Try to get her in. She threw like $50 in there. Like you can do.
Yeah.
You know what I mean? You can get started on that. And then like both of us, I think, did, definitely more so you than me, start with stocks and grow that. Granted, right, it's going to take years. The more you invest, the more you get a return, like the higher ROI. But then you can use that and transfer that into the real estate market. But I was just saying, like, if capital is something you're still working to grow, but you want to do something by trying to save up for real estate, you could put in the stock market. It's just way easier. And then again, depending on your time, as we stated, they can be passive as well. So that's one thing I did want to say. Like, it's if you want to get started ASAP and capital is a thing that's holding you back, feel free to throw some in the market.
Yeah. I mean, like counter to that, I mean, at least in this example, we're talking about putting 20% down, which is probably the most traditional I don't want to say the most common way, but it's the most traditional way.
Yeah.
And I mean, if you're strapped for cash and you're really determined to go into real estate, like I say, you can go into it with 3.5% down with FHA or 5% conventional. And even, for people in the military or veterans, they're going to have the 0% VA
Oh
loan.
yeah, that's a whole nother. Yeah.
So not necessarily, I'm just pointing it out, not to sway the argument between stocks and real estate, but if you're strapped for cash, you can get into real estate.
Oh yeah.
Low money down. It just increases risk on the back end because your mortgage payment is going to be much higher than if you put 20% down.
Yeah.
So,
and even in the lowest case scenario for real estate, 20% down, or if you get like 3.5%, like it's still gonna be a couple hundred, or not 100,000, a couple thousand.
Yeah.
Even in the best case scenario. So if you got like a grand or two, like you ain't probably not gonna find nothing really. You know what I mean? Yeah. But no, it's good to mention because our example is very much like it is one like 20% down. Again, it's just the norm or what you see the most typically. So that's really good. Yeah. All right, what else we got for comparison's sake?
I don't know. It just kind of depends on, like, they kind of go into the nuances side, right? Like I think the biggest conversation with stocks versus real estate is how active you do want to be, right? Because regardless of how intense you want to get about the stock market, like, there's so many options to just go full passive, right? You can try to chase higher returns in the stock market by individually picking your stocks, which, I mean, if you're a decent, not going crazy with the risk, like, you can achieve. But to do it over consistently for 30 years, that's where people get in trouble.
Yeah.
It's almost practically
you're not going to beat the market. Yeah, that's what I said. Like, you're not going to beat the market. Yeah. Very
you can definitely have one or two winning stocks here and there. But yeah, like the consistent piece, that's the hardest thing.
Right.
So it's interesting. You can get very active in stocks. Like, you can trade, which a lot of people lose money on trading too. Just go visit Wall Street Bets. It's the more hours you put in doesn't necessarily guarantee more time or more money that you're going to make in real estate or in the stock market. And it may just be better to put it in passively.
Something passive.
Yeah. So I think a lot of, high earners, people across all wage brackets, they can treat it as like a little savings account to, just grow your money. And because it's so liquid, you can cash it out at any moment and use it for whatever you want to do. Whereas on the real estate side, generally, the more hours you put in, you're going to find out, like, hey, this might be a better place to invest in this place. Right, like you go drive the neighborhood and be like, okay, this neighborhood I just feel weird about.
Yeah.
Whereas this neighborhood, I just have such a good feeling. The neighbors are nice. Like, you see good like constructions. Like, there's a park getting built next to it, stuff like that. And then you can, with more hours, I think you can try to increase your returns much easier than in the stock market.
Dude, that's an interesting point. So basically, what I'm hearing is you think your ROI on your time invested in real estate is higher than in stocks.
I do think so.
I do think so. Yeah. Because like you said, like, I know for sure as an individual, like if you're managing, and you can have like mutual funds, which are like managed by professionals, whatever. Again, other ways to utilize stocks. But yeah, if you're just like managing your own stuff, like all the time it takes to research companies and whatever else you got to research, vice the research you're doing for locations for your home and home buying. No, that's a good point. I would probably agree, actually. Yeah.
And it's like hard to recommend real estate because of the active piece. Because like if you're gonna get into it, you want to get into it, right?
You can't tell somebody how active to be, though. Yeah.
Yeah. So that's why, like, if someone's job is like very important, and then they have to dedicate most of their, like, like if someone's like a director at a company. Like, I'm just not going to inherently recommend real estate. Like, I think they should buy some. But to be a real estate investor, like, you're kind of picking up another part-time job, or that could even go into a full-time job if you don't have the systems in place.
Yeah.
So that's going to be a hard portion, I think. I'm lucky because I have my wife manage all the real estate, and then I'm just kind of focused on the buying and the strategy behind it.
Yeah, you guys got a good system.
So that's one thing. Like math wise, we kind of walked into it. There's so many nuances that we didn't cover, and people are going to be like, oh, what about this? What about that?
Oh, yeah.
Sure, there's what about this? What about that for both sides, for stocks in real estate. And I do think over 30 years, those kind of add and subtract and kind of average out. So that's why I just said, hey, let's not look at it. But on the money-making side, if you go with the very average everything, real estate will give you better returns. Until you're like 27 or whatever we talked about, right?
Yeah.
Which not a lot of people talk about. I usually never hear, conversation around how, I always hear stocks or real estate, one of them is better. They don't really necessarily talk about, hey, based on the math, it might be better to invest in real estate for up to the first 13 years and 8 months. And then from there, based on our research, like it might be better to do stocks or real estate after that,
Yeah. No, that's awesome. Actually, a group of guys I work with, we're talking about having a lunch in the near future that's just like financial based and kind of talking about like what each of us are doing and bounce ideas off of each other and get ideas from each other. Because I think people do need to talk about this stuff more. And to bring it all full circle, again, which is better, stocks or real estate? As you can see, it's like evident in this conversation. It's highly personalized. So it's kind of dependent on what you want as an individual. And also within that, regardless of what you want, it's also very nuanced as well. How long you hold for. With anything, the earlier you start, the better. You'll probably be able to increase your returns and then have more to play with later on, or just be able to hold it for a longer period of time by virtue of, you being younger. So I think the key foundations of all of this is just to have more conversations, read more stuff, figure out everything you can about both stocks and real estate, and, all the other investment vehicles out there. But, in this topic specifically, find out what you can and just, if it's something you're interested in, just get started in it.
I think like the most important thing is to get started.
Oh man.
And in that sense, I think it is easier to get started in the stock market. Because you can literally put in $50 and tap a few buttons and, and then now you own a stock, right?
Right. And this stuff can be fun too. Like especially once you get rolling and kind of foster a sense of like direction or what you're doing, like you can certainly be, not just say it's just a game, like you're just like throwing your money to the wind, but no, it definitely can be fun. I have a question for you. You mentioned earlier, which I know, and you mentioned in a couple other episodes that, one of your favorite books. I don't know if it is your favorite book, probably financial book at least. Rich Dad Poor Dad.
Yeah, probably my number one.
Okay. Yeah. I want each of us to give a recommendation for a real estate book and a stock book. I'll be honest, I don't even know. My stock book literature is very low. The only book I can even think that I read of that kind of touched it is Little Common Sense Book of Investing, which honestly,
that was a good one.
It was okay. It was okay. Good baseline, but like it's definitely a good like starting point for sure. I thought it was okay, but I only threw it out there because I think that's like the only one I even have that I read. But for real estate, for me, one I thought was really good was, which again, shout out to you. This is a recommendation for you. Is was it the house hacking?
Oh yeah, house hack book. It's by Bigger Pockets.
Bigger Pockets. Craig
something. Yeah.
Craig Krulop. I think it's called the house. Oh man,
it's a
house
green
hacking
book.
Strategy. The house hacking strategy.
The
by
white
Craig
and green.
Krulop. Yeah, that. Now it's centered around real estate investing and all the avenues and different methods for that. But if you're anybody interested in real estate investing, super good read. Actionable things you can take from there. The jargon is like easily digestible because again, I'm not. B knows like far more about this stuff than me. But like I had notes. Like I've pulled it back off the shelf and like flipped open to a tab page, like refer to it. Just I highly recommend for me. So I wanted to get one in each category from you as well.
Yeah. So before I get into the books, that's actually a good point that you brought up. With stocks, you can do 10,000 hours of research on one company.
Right.
and you can have absolute determination of what's going to happen, you're still not going to influence how the company does.
Mm-hmm.
Right? But real estate side, with what you know and what you do, it could just as go the wrong way.
Right.
But if you do the work and research and you know what you're doing, usually what you put into the house kind of returns more than what you put into the house.
Right.
On the equity side. Like, for example, one of the houses I own, we have like a little lot in the back.
Okay.
Little backyard.
Yeah.
Nothing big.
Backyard action.
We're building a mother-in-law suite called ADU, and it was about, it's nothing. It's very small. It's like 350 square foot studio, and it's gonna end up costing us about $85,000 to build it.
Okay.
And usually, like you said, it's going to depend on the appraiser when they officially appraise it. But the general rule of thumb is with not attached units or detached units, you can consider 50% of the price per square foot.
Okay.
And I just add it to your I guess, like, phantom guesswork of how much the house is worth. And, like, for example, like, I'll just give rough numbers. It's not exactly, but it's around the same. Like, I bought this house for a little over $500K, but we'll say $500K.
Okay.
And it's about 1,300 square foot. So with that $500K divided by 1,300 livable square footage, that's about $884 per square foot.
Per square foot, yep.
And let's say we divide that by 2, right? Just like we talked about for the detached units. So detached units could generally be appraised at around $192 per square foot in this particular example. So I multiply that by the square footage, let's say 350, and the detached unit cost me $85K, and it's worth $67K technically.
Right. Okay.
So with the actual money that I lost in the labor and the material, whatever, it was about $20K, right?
Mm-hmm.
But then with that $20K that I spent, technically, like, I can bring in another $1,500 in rent because I'll be renting out the back unit. Right. So with that, like, rate of return, let's say 1,500, you got to keep, 500 and for the utilities that they're going to use and a little bit of reserves. And let's say you're taking home 1,000. Multiply by 12, and you get 12,000
for 1 year. Yeah.
And 1 year of return divided by the $20K that you put in, that's a 60% return.
Yeah.
Right, like, that's crazy returns for someone else to build it, and then you have the property manager put in a tenant.
Right.
And I mean, that's stuff like that you can do in stocks.
Yeah, exactly.
Then a lot of the flips on the real estate side of remodels is definitely super active compared to the stocks.
Oh my God, yeah,
but you buy something at 300K, you put 100K of work, and you sell it at 600K, which I think is a similar concept to just trading, but you can also do that while you're living in the house, like slowly fix stuff up to make it to keep up with the times and the trends. And when you sell it, even though that property value should have appreciated to, let's just say 800K, let's just say.
Yeah.
But because you put in 50K of work right before you sold it, it sells for 900K.
Crazy.
Right? So that's the knowledge piece that you can't really apply, regardless of how much you know about stocks. You can't influence how the company does.
Dude, well said. Yeah. I would see these, like, crazy flips on Instagram where it's like, they show a house in, like, 2010. They were like, this house was, or maybe not even that far. It'd be like 2015 or something. Like, this house was $300,000. And then they show the update. They'll be like, how much do you think it's worth now? And it's like 1 mil or like something crazy. Or it wouldn't even be that long. It would be like from 2018, like a couple years ago. And it's just like whether natural appreciation or like forced appreciation, especially if you're forcing appreciation, can just be crazy. But again, just way more active. It just takes a lot more work, which, I mean, that's a theme of life. Like, the more work, the higher your chance for reward, or in this case, like your return on your investment.
Yeah.
So I think that checks out. All right, what recommendations you got?
So books, I mean, real estate side, I mean, it's going to be Rich Dad Poor Dad, but I feel like if someone's into finances, the chances are they already read Rich Dad Poor Dad. So I gotta go to the books that I've read.
Yeah. Give me something good.
Because Rich Dad Poor Dad is definitely more of a mindset book rather than a strategy.
That's why I try to give something that's like specific to those topics, because we've read a lot of finance books, but like, if you have anything specifically on real estate or specifically on stock.
Yeah, shoot, that's gonna be hard.
If not, just give us a finance one.
I mean, I
know you got some.
Strategy wise on the book side, I think The Small and Mighty Investor. It's also by published by Bigger Pockets.
Okay.
And it's by Chad Carson, if I remember correctly. And the premise is like, with real estate, so many people, so many gurus, if you want to go into it like 100%, they're like, hey, do this, do that, go into apartment buildings, and you're gonna make so much money, blah 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 blah. But like, you don't have to do that. A lot of people don't talk about like, hey, like, you can, over the course of 30 years, you can buy 5 houses and pay off those 5 houses with the rent that you get, with the additional money that you bring in. And at the end of 30 years, like, usually rent and appreciation is going to kind of keep up with the inflation, right? So tomorrow's dollars, we can, for the argument's sake, we can kind of talk about in today's dollars. But let's say in 30 years, when you retire, you have 5 houses paid off, and you need reasonably $7,000 to live comfortably monthly.
Yeah.
For your food, travel, hobbies, whatever.
Right.
But you have 5 houses renting it out $2,000 each. You bring it in $10,000. There's no mortgage on it. You save $2,000 for maintenance and vacancies and whatever.
Right.
You're still bringing in like $8,000.
Oh yeah.
And you can save that $1,000 or do whatever with that $1,000. Right. So that's what the book talks about. Like, you don't have to have a $300 like a unit portfolio to retire comfortably, right?
Yeah.
And it's just another take that a lot of people don't offer, which I appreciate. Like, he breaks it down.
That's really good.
Yeah. So that's the real estate side. And the stock side, like I said it in the previous books versus movie episode, but Psychology of Money, that's not gonna, nothing's gonna beat that book for me for at least a while. Like, it talks a lot about the mindset and the actual strategy side of investing, which he talks a lot about stocks.
Okay. That's good. That's still I haven't even read that one.
Yeah.
That's really good. And yeah, go ahead.
I think it's good. I recommend people to read Rich Dad Poor Dad and Psychology of Money, not together, but like in sequence, or, just read it eventually, because Rich Dad Poor Dad was really good for the mindset piece of, hey, like, I'm so motivated to get started. And then on Psychology of Money, it kind of brings you back into reality of like, because you read Rich Dad Poor Dad, I'm like, dude, like, I'm gonna do this, like, I'm gonna try to retire in 10 years, blah blah blah. And then you read the book, I'm like, okay, like, this is more of a realistic expectation, and the execution that I need to hold.
No, that's good. All right, that's cool. And I love, like, you brought up about, not Psychology of Money, what was the first book?
That was A Small and Mighty Investor.
Yeah, how you're saying it's
Small and Mighty Real Estate Investor.
Small and Mighty Real Estate Investor, how it's not, it doesn't give a one size fits all approach. Because in most of our topics, or just a lot of things, especially that are advice driven, whether it's like financial books, self-help, you name it, it's like, hey, if you do this, this will be the end state, or like, this is the best way to do it. And like, that's just not always the reality. And even if it's data driven, like, most people that do this, like, everybody's situation is different. So I appreciate, and I think we try to do, which is, in this episode, we keep it very neutral and like speak on averages. Because again, we recognize that everybody's situation or mindset, circumstance, what have you, may be different. So I appreciate that book kind of took a counter perspective like that as well. Was like, hey, like just because this works for all these people, there's other ways to meet the same goal or to go about this. That's super dope. Cool.
Yeah. In regards to the conversation, like if you're seriously considering which one is better, real estate or stocks, like, I don't think that's the right question to ask, to be honest.
Talk to me.
Because you can make money in stocks and in real estate. They're both trillion, quadrillion dollar markets, right? So I don't think it's like, I mean, you can literally, pick one because of you like one over the other, and you can go fully into it. And who is to say that like you have to pick one?
Or you can
right?
do.
Because like right now, with my age and with the properties I own, I'm sitting very comfortable. So my goal right now for the near future is to just save a lot of cash. And how I'm going to save a lot of cash is by just buying up stocks again. Because my stock exposure is very little. Like I have a little bit in my, I have like 100K in my 401k.
Okay.
And then besides that, I have my like company stocks that they give me every year.
Yeah, that's your job. Yep.
But besides that, I'm not really exposed to the stock market. So while I save up, the ultimate goal for me is real estate. But in the intermediate, to have more cash to play it safer.
Kind of supplement the real estate.
I'm not aggressively chasing the best rate of return. I'm chasing return high enough that meets my lifestyle.
Nice.
So my thing is like, hey, I'm gonna start getting back into the real estate game, and as real estate opportunities come up, I'm totally okay liquidating my stock account to use for real estate. And I think a lot of people, generally speaking, I think it'll be good for people to, even if they're investing in stock market 100%, like it'll be okay, it'll be cool. I think it'll be good overall to buy the house that you're going to live in for the next 30 years.
Yeah.
Right? Because even if the returns may favor stocks in over 30 years or, before 30 years, it could be real estate, whatever the argument is, like you're still living in a house that you can grow up with your family and you can paint the doors whatever you want because it's your freaking house.
Right. You're going to be a house regardless. So, yeah.
So, I mean, there's values that, houses provide outside of the return. Even if you're Mr. Stocks, I only care about stocks, it's fine. You're gonna make a lot of money if you do it right. Nothing against buying a house either.
Yeah, that's money. So what I'm hearing is, in conclusion, one's not really better than the other, right? So anyone can make it work for you. You can do one, then the other, like starting stocks, getting real estate, starting real estate, getting stocks, like B just said. You can do them simultaneously. I think your plan is pretty cool. That sounds like almost have your stocks supplement your like real. So there's not one or the other, which they're commonly painted against each other. Like which is better, which does not need to be the case. Like do what works for you. And it's all said and done.
Oh yeah, that's the point of that's the take that we're taking.
Yeah.
The common belief is that it's stocks
like,
or real estate.
One? Like no.
Oh yeah, it might be better to just kind of factor in both.
Absolutely.
Do what makes sense for you, or even do both if it makes sense for you.
If you can and it makes sense, go for it.
Okay. But with that being said, for the average person that works, I don't know. So they're married, they have 2.1 kids, their household makes $85,000. We'll say 100K household.
Just keep it easy, yeah.
Just easy numbers. From your point of view, they're late 20s to early 30s. What should they invest in?
I'm gonna say.
Which one do you like?
I'm gonna say real estate. And again, we kind of laid out for some of the dynamics for both, but I think real estate is, you said late 20s.
Yeah, late 20s, early 30s.
Yeah. That's still like fairly young in the grand scheme of things. What's the average lifespan of an American? Is it late 70s?
Yeah, can say 75.
We'll say, all right, 75. Again, right, there's 15-year mortgages, 30-year mortgages, whatever. 30-year mortgage, let's call it 30, you're 60. If you hold that mortgage for the whole time, again, this is assuming a lot of things, but you still got 15 years, you have a it'll appreciate. You'll have a home that you own outright. You can leverage that. You can borrow against it. You can use that for something else. Like you'll have at least 15 years on the back end if you don't finish your mortgage early, whatever.
Mm-hmm.
And again, it's low, especially if you're living in it. Even like more passive, you don't have to manage. I mean, you manage it, but like you're in it, you're your own tenant. I'm gonna say real estate.
Okay.
I'm gonna go real estate. What's your?
For that average description that I just gave, I'm gonna have to go with stocks.
I'm gonna say real estate. Yeah. I mean, there's probably personal. I mean, it's not me in the situation, but yeah, I would say real estate. I like the idea. I mean, stocks is an asset too, but
some people, yeah, like a lot of people, including me, it's kind of cool to be able to touch your assets, right?
Yeah.
Where stocks, it's just a screen, like number on a screen, which is also cool too. But
I mean, I'm definitely not. I'm working to become more of a, I don't say numbers guy, but like working with the numbers. But just being able to have that asset. I mean, especially again, different if you're living in it, and to build it up, like you say, force the appreciation, and build it up, and then you can sell. You can even, you don't have to stay in it 30 years. Rent it out after a couple years, whatever. I think that's really, I don't know. I think it's really cool. Granted, I did say earlier I like diversification, so I do like stocks for that reason. That you can tap into a lot of different things.
See,
But
they're both good.
if I just had to have just one, like if I had to choose, I don't know. I think one or the other. At that time, I'll probably do real estate. Yeah, dope. All right. Well, you got anything to close up?
I like the conversation. It's not this or that. You can have both, and it's okay even if you pick one.
Well, you heard it here first. It's another episode of Rebel Wisdom. We'll certainly catch y'all next week. Thank you for joining. We're out.